Interactive Brokers, and thank you for joining today's webinar. Something big is coming to equities trading. It's the Micro E-mini future contracts that CME is launching on May 6th, next Monday. We do appreciate you joining us here today to discover the benefits of trading equity index futures for a fraction of the financial commitment. Here to explain the 4 new index contracts for individual traders is Dave Lerman, Senior Director of Education at the CME Group. So with that, please join me in welcoming Dave. I'm going to make you the presenter, and let's all welcome Dave to today's presentation. Thanks for joining us, Dave. If you can share your screen, we'll get underway here.
Thank you very much, Cynthia. I assume everybody can hear me okay? Are we good?
We're good. Here comes some more yeses. So yes, we're all
good.
good.
Okay, good. All right. Well, thank you very much, Cynthia. Again, on behalf of the CME Group and myself and my esteemed colleague sitting next to me, Craig Buick, who covers Interactive Brokers, I want to say thank you very much for Interactive Brokers for hosting this webinar. And we're gonna dive right in. So something new is coming to equities trading May 6th. Actually, this coming Monday trade date, May 6th, we will launch this contract, but they'll start trading Sunday night, 5 o'clock Chicago time. But that will be for trade date Monday, May 6th. Couple real quick disclaimer here. Neither futures trading nor swaps trading are suitable for all investors, and each involves the risk of loss. So as this webinar unfolds, we'll be telling you many times to do your homework. Usually IB has a much more sophisticated crowd that's listening, so we're going to dispense with some of the basics here, but you got to do your homework with futures and options on futures. It's something that's necessary. We don't want anyone to have any undue losses. We have a little humorous thing here. Yeah, but can you beat the S&P 500? This is a comic, a little humorous comic that came out of a book, and basically it spawned the entire revolution that we now get to enjoy in terms of trading the E-mini S&P 500, the standard S&P 500, and soon to be the micro E-mini S&P 500, along with all the other micros that we're going to launch and 3 other products. But back in the middle 1970s, a lot of people decided that, you know what, it's getting really hard to beat the S&P 500 over the short term, long run, medium term, whatever you measured. Most active managers weren't doing it. Passive management ruled the day, and that's where indexing began. And as we know now, we have a whole plethora of products. We have mutual funds, we have ETFs, but most importantly, and at the top of the liquidity pool is stock index futures contracts on the S&P 500, the Russell, the mid cap, the NASDAQ. And it's been an incredible revolution, but beating the S&P 500, it's been a challenge for most managers. As a result, indexing has grown to like a $4 trillion industry, and the derivatives along with it also. And that's what gave us a very liquid pool of stock index futures products. We started back in 1982. We're going to give you a little bit of history here, about 5 minutes, 7 minutes of history, and then we're going to get into some of the contract specs. Then we're going to talk about what you can do with these things in terms of strategy and flexibility. So we started in 1982 with the standard pitch-rated S&P 500. It was open outcry. It was traded on the floor, and then as things happen over the next few years, this great bull market and the notional value of the contract grew so much, we launched an E-mini, E standing for electronic, mini being a miniaturized version of the standard pitch-rated S&P 500, and it was launched on our Globex trade matching engine system. And you know the rest is history. It became one of the most successful futures contracts in the world. What I have here on this next slide is the top 10 most active futures contracts. You could say top 10 most liquid too in a certain way, although liquidity isn't always measured in terms of volume and open interest. It's bid-offer spread, size of bid-offer spread, depth of order book, as you all well know. But I want to call attention to, but many of you probably have figured it out already, in the top 10, the CME Group's been very, very fortunate. We own 4 of the top 10 positions, and we own 2 of the top 3 positions in the E-mini S&P 500 with 1.6 million contracts traded every day and an open interest of just under 2.7 million. The average daily dollar volume, we'll talk more about that later, but it's closer to about 220 actually at this point. Mini NASDAQ, about 500,000, open interest 200,000. Down in position number 6, I believe, is the mini Dow, and then at number 10 is the E-mini Russell 2000 futures contract. So A big thank you to Interactive Brokers, because a firm like that has helped us become successful in stock index futures contracts. And we would never get 4 top 10 places if it wasn't for the active trader out there. They're the ones that populate the depth of order book. They're the ones that do a lot of trading relative to maybe a pension fund that only trades 4 times a year when they roll their contracts in March, June, September, and December. So again, a big thank you to our customers out there that trade this. We're hoping that at some point the micro E-minis will hit this top 10 list, but nothing is built in a day. It takes time. The E-mini S&P 500 did it pretty quickly, though. We started out, doing about 10,000 over the first year, doubled the next year, and then went to 100,000 quickly, 500,000 quickly. Within 4 years, we were trading at about $1 million a day, I believe. So why the micro E-minis and why now? Well, we needed to resize for individual traders. Over the last 10 years, we've had such a growth in, because of the bull market in equities. The notional values of some of the stock index contracts are 2 or 3 times what they were back in 2007, 2008. As a result, it's kind of priced certain traders, smaller traders, less well-capitalized traders out of the market. So that leads us to No Trader Left Behind, a little play on the words by George Bush's No Child Left Behind. We want a product suite that offers a wide universe of traders the ability to trade. So the solution we came up with was a 10-for-1 split, if you will. Now, we're not splitting the S&P 500 cash index. We're not really splitting our futures contracts. We're going to be launching a 3rd generation of stock index futures contracts. The micro E-mini is a separate contract. It's just got a 1/10 the size of the E-mini S&P 500. That's why I refer to it as a 10-for-1 split. So you get a shot 1/10 the size of a contract, but you get all the benefits afforded to trading our liquidity pool and our infrastructure and a stock index quadrant that's second to none. The landscape is ripe. I think this is mostly customer dominant, dictated, because we've had a lot of people call and say that, the notional values of some of the contracts are getting really big, and we'll talk more about that in the next slide or the one after that. But as we say, our notional values for stock indexes, they've increased substantially, and actually they're larger than most of our other contracts. If you compare the mini S&P to copper, to gold, to soybeans and corn, we're much larger in that. So this gets to the point where the initial upfront margin starts to price out certain traders. So we wanted a contract that benefit new traders and those with smaller accounts. So also our micro will have many advantages when compared with ETFs, just like our other stock index futures have advantages over ETFs. We hear from brokerage firms all over that there's been a lot of new futures accounts that have been opened, but traders haven't commenced trading yet. We think this is a contract that'll be a catalyst for people to do that because of its small size. So again, we're going to have a contract that has all the great advantages of our equity product suite, but at 1/10 the size. The nice thing about it can be used by traders, but also hedgers, those with maybe even an options position or an ETF position or a mutual fund position. If you want to hedge, this will allow you to do it. And allow you to do it in such a way. The nice thing about when you're hedging, you don't disturb your original position that's being hedged. So if you have an ETF or a mutual fund position and if you took it off instead of hedging, you would have a taxable event and you would lose your dividends. On ETFs, you lose your dividends. Stocks, you would lose your dividends. If you hedge, you can keep your position on and hedge against adverse moves, but you'll still keep your dividends and you won't have a taxable event by selling. So that'll be a good thing. Some firms' clients are just not eligible to trade stock index futures because of the size. They don't have enough capital in their account. Again, we think this will help resize things that'll bring in a wider swath of traders. Also allow newer traders to reduce risk from 2 viewpoints. One, the upfront margin that you put up is much, much smaller, 1/10 the size, basically. And the dollars at risk, because of the smaller notional value, the amount that you would lose or gain on a trade is smaller. And here's a bar chart that shows what I was trying to explain. You can see the standard pitch rated S&P notional value is about $700,000. The margin on it is $30,000. That prices out a lot of traders. And back in 1997, when we launched the E-mini S&P, this is what happened. A lot of traders just didn't have an account size big enough to be able to trade it. So we launched a smaller version of the standard S&P, and the margin was much smaller. And the rest is history. It became the most successful stock index futures contract in the world. The mini S&P is about 145,000, the margin $6,000, all the way on down there with the mini NASDAQ, gold, copper, crude, and you can see. And then inlaid into that chart, I show the approximate notional size of the proposed micro E-mini S&P, the micro E-mini NASDAQ, the micro E-mini Dow, and the micro Russell 2000. This is based when I made the slide. They're probably a little bit larger at this point, although the market's selling off again today on top of yesterday. But we're right around 14,000 notional value for the S&P, NASDAQ, and Dow micros, and the Russell 2000 will be about just under 8,000. And the margins will be dramatically lower too. We're going to get to that in the next slide. So again, we're trying to address all traders. We're trying to get traders that were just priced out of the market by this large bull market that makes notional values out of reach for people. So there's the great bull market that's been interrupted by two bear markets. Fortunately, they were rather swift, except 2008 was pretty wicked. We were dropped about 55%, but we launched the standard S&P back in April of 1982. We did just under 4,000 contracts. Well, we followed up with the standard mid-cap 400, the Russell 2000 in 92 and 93 respectively. And then we had this great bull market in the 80s and the 90s. The value of the S&P 500 made it to $500,000. If we had a 1% move, which we had frequently back then, you were moving $5,000 a day. This is a bit much. There's very few futures contracts that move $5,000 in a day. Even Bitcoin at this point is not moving that, even though it was when it was back up at 20,000. But so in 97, we are actually, it's deja vu. We're in the same position now that we were in 1997. A little bit too large on the notional value and the margins. So, but we launched in September of 1997, the E-mini S&P. We did just under 7,500 contracts a day. And again, we followed up with the E-mini NASDAQ 100, E-mini Russell, the E-mini Dow in 99, 2001, and 2002, respectively. Which brings us to a few days from now, May 6th, when we're going to launch the micros on the S&P, a micro on the NASDAQ 100, and the Russell 2000, and the Dow. Okay, so why should you trade these? They're the same reasons you'd want to trade any future, but they're especially pertinent for the micro E-minis. One, execution costs and liquidity. Futures contracts, pound for pound, tend to be more liquid and very, very cheap in terms of execution costs. If you compare them with some other products, you'll see the costs are really, really cheap. You control a large notional amount, which brings us to number two, capital efficiencies, with a much smaller amount of money. And all these things add up to efficient trading. Number three, around-the-clock trading, which we all know about with futures for strategic reasons. There's things you can do with futures contracts that you cannot do in the stock market. You can sometimes, but it's much more expensive. You can do spreads if you want to spread small caps versus large caps. If you wanted to do like certain intra-month spreads, spreading one month versus another, you can do that very easily with futures contracts. The fifth reason, pure direct play. Instead of playing the FANGs, for example, or one particular single stock, you can play the entire market. So again, you get diversity, a lot more efficiency, and the S&P, the Standard & Poor's 500, is, I think there's $3 or $4 trillion indexed to it, if I'm not mistaken. So again, a huge amount of critical mass, a term I'll be using a lot because it helps engender liquidity for traders. You have number six, be careful. We have full offset with the E-mini futures. In a way, it's fungible, but it's only fungible with offset. So in other words, we'll talk about it a little bit more later, but if you have one E-mini and you're long and you short 10 micro E-minis, you will offset, your position will be flat. So you can't convert, you cannot take an E-mini and convert it into 10 micros. That you can't do. You can offset one with the other though. Seventh reason is our clearinghouse, a wonderful, wonderful entity that we have here that it forces active risk management. For those of you that don't have well-established risk management skills, futures are a place where they will become well-established, because if they're not, you'll be forced out of your position if you have an adverse position. So the clearinghouse is a good thing. They create the margins, they change the margins when necessary, depending on notional size and volatility. And it's a good entity, and clearing firm like Interactive Brokers will help do that too. Risk management is paramount in futures. You have to have good risk management practice. Number eight, you get more precision in terms of fine-tuning your exposure, so you can scale in and scale out instead of having a one lot and maybe it goes your way and you sell it and you make a profit, but that's it. If we keep going in your direction, you're out of the trade. Well, micros will allow you flexibility. We'll have an example, a real life example with that a little bit later. Non-tax considerations. We'll talk more about this later, but this is the biggie. This is what gets a lot of people from trading stocks and ETFs to coming over to trading futures. It's just you pay less taxes when you trade futures contracts. Technical indicators, any fundamental and technical analysis you do with stocks or ETFs, it's applicable to the micro E-minis too. Charting techniques, they'll be available on all the quote vendors too. Although the E-mini S&P 500 is so big and so liquid, you can do your charting off of that. The micros should trade similar, which is no guarantee here. We're going to have disclosures on this too. There's no guarantee the micros will trade at the exact price as the cash or the E-mini S&P or the standard S&P, but they should be close, but that's what we're hoping. They offer a lot of advantages that equities and ETFs don't, which we've already covered. 12th is just I won't say a commercial for the Merck, but we have been in business almost 2 centuries. So we know what we're doing. We have a lot of infrastructure. The clearinghouse has decades and decades of experience of this. So that's a plus in our favor. All right, so real quickly, we're going to go over these contract specs. Most of this chart, the vast majority of it, the bottom 2/3 is almost identical to the E-mini S&P 500. The amount of contract months that are offered, the quarterly cycle, March, June, September, December, the trading hours, trading ending, the SOQ, special opening quotation, the cash settlement, all the price limits, whether they be overnight price limits or the regular trading hour price limits, are all the same. The only thing you need to do is memorize the ticker symbols, and the contract multipliers are 1/10 the size. So with MES, the micro E-mini, it's just the ES, the mini ES, with a M in front of it. So MES is the ticker for the micro E-mini. The contract multiplier, instead of being 50, is 5. So 5 times the S&P 500 puts it right around $14,000. The price fluctuation, the tick is the same as the mini S&P in points, but because it's a 1/10 multiplier, instead of $12.50, it's $1.25. So the tick in points is the same, but in dollars it's less, 1/10 as much. And all the way on down the line with the micro E-mini NASDAQ, the micro E-mini Russell 2000, and the micro E-mini Dow, everything's the same except the multiplier and the tick size in dollars. Calendar spreads you can read on your own. Not sure how many people are going to be doing calendar spreads with these things, but it would be good if people want to roll their position and keep a winning position going. A couple other little just pieces of information here. This is a print screen that comes from our website. It's as of April 23rd when I made this slide. It'll show you. You can go to our website. It'll give you the June, September, December, March. This is E-mini S&P now. The micros are not trading yet, so obviously we don't have any prices. So it's not a far-fetched statement to say that they should trade very, very close. But remember, this is hypothetical at this point because the micros haven't started trading. And any projection based on the expectation that the pricing of micro E-mini futures will track the E-mini futures is just that. It's hypothetical. Again, because of arbitrageurs, spreaders, we have a great market maker plan in progress, or that will be from day one that will be started. It's pretty good that they'll trade very, very close to each other. If they get too far apart, spreaders and arbitrageurs will come into play and try to profit from those discrepancies, therefore bringing them back into line. But there's no guarantee that they'll trade at exactly the same price as the E-minis. But they should be close. That's the hope. Excuse me, let me go back to that for a second. On the bottom, I just show how you quickly calculate the notional value. 50 for the E-mini, it's 50 times 2938, which was what the S&P was at level at that time I made the slide, 146,900. The micro E-mini is just 1/10 that, 5 times 2938, or 14,690. One last just general information slide here. Actually, there's a whole bunch of them, but again, it's got the ticker symbols, it's got the initial margin, and remember, subject to change. This margin could change dramatically. If implied volatility spikes to 40% in the next 2 days, expect margins to go up in the minis, and therefore they will go up on the micros before launch. So these could be dramatically higher, they could be lower, they could be the same. Margins are subject to change. So we give the initial margin, we give you the maintenance margin, margin as a percent of the notional value, maintenance margin, futures price, multiplier, notional value, and below it I just summarize the multiplier for the minis and the multiplier for the micros. Just 1/10 the value. All right, so let's look at a trade. This was a real trade. It was actually done by a friend of mine that runs a hedge fund. And this was a trade done, but it was done in the E-minis. Again, micros aren't launched until Sunday night. for Monday trade date, so you can't trade the micros yet. But this is going to illustrate something that needs to be pointed out to certain traders, especially new ones, novice traders, new traders, people with less than a certain amount of time of trading experience. We wanted to point this out as in terms of perspective from 3 generations of product. So this is a trader. He's got a system. His name's Larry Epp. He's a friend of mine. He runs Trans-Rubicon Trading. He's got millions of systems, but one of them is with an RSI and tied to volatility. Anytime you get an RSI below 20, which is usually pretty darn oversold in the S&Ps, usually that's accompanied by spikes in volatility in either the VIX or the at-the-money implied volatility of the at-the-money options or the at-the-money straddle. And volatility above 30, RSI below 20 generates a buy signal. So you would exit the trade upon any RSI reading above 70. This happened on 12/24, actually Christmas Eve and February 20th, respectively. So he got a signal. So how would the big, how would the mini, and how would the micros, assuming they were trading, have done? How would the margins have been? How would the P&L have been? So at this point, if you're a new trader, you got to ask, what's your risk tolerance? How much capital do you have? On the next slide, you have the chart. There's that ugly fourth quarter with December completely falling apart and bottoming right around Christmas time. The bottom frame of that chart, you can see the green line. That's the relative strength index, RSI. I believe it's a 14-day RSI chart. And you can see there as it heads into the red, that means your RSI is below 20. It made it down to 18.6, I believe. Then it finally, by February 20th, in the big rally, made it up to around 71, I believe. It just breached 70. So that's where the trade signal for entry occurred, and back in Christmas Eve. And the exit was on February 20th when we had a huge rally and the RSI hit 71. So how did it look? How did it look if you did a standard S&P versus the E-mini? How would it look if you did a micro, assuming the trade prices were the same? And again, micro's not trading yet, so this is kind of hypothetical projection. But you can see, I'm not going to go over all these numbers, but the notional value for the initial part of the trade, $588,000 for the S&P, $117,000 for the mini, and the micro E-mini S&P would be $11,770. Initial margin, $30,000, $6,000, and $660. Again, giving you scope between the 3 various products. Veteran traders don't need this, but newer traders probably should know about the size, the various perspectives here. The risk in points, this guy from Trans-Rubicon knew that the volatility was pretty high, so he set his risk parameters a little bit wider, 30 points. So the risk in dollars is, as stated, 7,500, 1,500 versus 150. The entry price and the exit prices for all the trades would be the same. Again, a hypothetical, assuming the micros were trading. The gain in points would be the same. The gain in dollars, as you can see, is vastly different. 109,000 versus 21,000 versus 2,100. And the notional value at the end of the trade, obviously, the standard S&P is a gigantic, large contract. But again, we put this in there to give you perspective on how the micro will look versus, already established contracts that trade and trade frequently. So some of the other advantages that we're going to talk about in doing stock index futures or micros versus the ETF out there. It's a ripe business. It's a big business. The ETF business is very, very successful. We're not here to knock ETFs. ETFs and stock index futures trade hand in hand. There's a lot of arbitrage and spreading going on between the two. They're both very successful in their own right, but futures markets are much, much, much larger. As large as the ETF market is, the stock index futures contracts are quite a bit larger, as you're going to see. So we have the ticker symbol there, MES for the micro E-mini, S&P, and SPY for the S&P spiders, the S&P 500 spiders. The multiplier, well, 2,800 at the time I made this slide times $5 a contract, roughly 14,000. We have contracts with SPY, it's shares, they're not contracts. So one share is $280. Notional value 14,000 versus 280 per share. Number of SPY to equal a micro, 50. So 50 SPY equals 1 micro contract in terms of dollar amount. Around the clock trading with micro, yes, just like the minis and just like a lot of our products. With SPY, only at maybe 1, maybe 2 firms can you trade spiders at night, and they're not very liquid. We tend to be pretty liquid at night. We have a worldwide infrastructure out there with lots of buy-side hedge funds, prop traders, everything, and there's some pretty good volume even overnight. Management fee, there is none with futures. With the spiders, it's 0.0945% per annum if you were to hold it that long, although it's deducted every day. A very small fraction is deducted every day. Average daily dollar volume of the adjacent E-mini product, well, we do 220 billion E-minis a day. There's 24 billion of the SPY. More on that later. Margins, you'll only put up about 4.5% to get into a micro. $660 as of now, could change. Regulation T margins require 50% if you do ETFs or stocks. Margin efficiency for spreading, there are plenty of them for micros, micro E-minis. If you wanted to do the micro E-mini Russell versus the micro E-mini Dow, you can do that. You want to do margin efficiencies for SPF versus something else, or SPY, excuse me. There are no margin efficiencies. You'll have gross margins on both sides of the trade, and that'll be costly. Some people can afford it, but many can't. Investor protections, there's the clearinghouse for futures and the Security Investor Protection Corporation for securities and ETFs. They both do fine. I think under duress, the CME clearinghouse is terrific. During the crash of '87, during the financial crisis, we had a long track record of many years where no customer ever lost as a result of a default of a clearing member firm. And in the problems we had in 2007 and 2008, there were problems, but customers really never lost anything because of that. So the clearinghouse is very efficient at risk mitigation. And the Security Investor Protection Corporation is just a gigantic insurance fund that's backstopped by Congress, I believe, if things were ever to get really bad and the guarantee fund ran out. It's got $4 or $5 billion in it, I think. I'm not sure exactly. Do not quote me on that. Regulatory agencies, the mini S&P, we have CFTC, Commodity Futures Trading Commission. Stocks and ETFs are our Security and Exchange Commission. Tax treatment on trades held short term. We have the 60-40 rule. Very advantageous for traders, especially if you're a good trader. It adds up. We'll talk more about that towards the end of the seminar. Stocks and ETFs, ordinary income on short-term trades. All right, a couple other slides here. This shows, it's a bar chart that shows E-mini S&P futures average daily dollar volume versus all three S&P 500 ETFs. The SPY versus the IVV, which is the iShare S&P 500, and the VOO, which is the Vanguard S&P 500 ETF that they have. And you can see in light blue there, turquoise, whatever you want to call it, that's the CME stock index futures. In gray is the exchange traded products, the three of them. And the line at the top is the multiplier. In other words, we trade between 7 and 10 times in stock index futures, trade 7 and 10 times more than the three ETFs combined. So again, great liquidity, a lot of money flows into futures. You'd be very surprised. Most of the primary futures contracts outtrade their ETFs by a long shot, and they also outtrade the cash market by a long shot. There's a couple of exceptions, but one of them is not stock index futures. One more slide about, comparing futures versus ETFs. The name of the game is liquidity. You want to know what you're going to get filled at. You want to know that you can do size necessarily and not worry about these things. Couple just quick numbers here. Again, the E-mini S&P trades 220 billion a day. On a good day, the average daily dollar volume of SPY would be 24 billion. So we do 9.2 times as much. The most incredible thing about the E-mini S&P, and we hope this translates into the micro too at some point, the micro products, is that the E-mini S&P outtrades all 7,300 ETFs around the world by a factor of 2.2. Mini NASDAQ, 67 billion versus 6 billion for the ETF, and the Dow and the Russell respectively way outtrade the ETF. Now, these are E-minis. We're talking about micros for the most part. How will the micros do? We don't know for sure, but there's the good indication, great buzz. So we're going to have some pretty good liquidity here. We'll talk about market makers a little bit later, but we have high hopes for this. So we can't make predictions on volume or liquidity. We never know. We never know that. No one ever predicted the E-mini S&P 500 would have the success it did, but it did. So it's very interesting. We get nice surprises sometimes. But in stock index futures, we've been very, very fortunate. And again, thanks to clients out there that are trading it. So how's the CME Group done with micro products in the past? This is not, we've been around the block a couple times on this, and it's actually pretty decent success. We trade a mini crude. It's not a true micro, and there's no plans for a micro crude at this point. So that's a really popular question. There's no plans for a micro bond, no plans for a micro crude. We do have a mini though, and it's about $32,000 in notional value. So that's pretty small. That's good. Average daily volume 18,000. We have a micro Euro FX, does about 17,000 a day. It's 6.47% of its larger contract counterpart. The mini crude is 1.5%. We have a micro gold that does about 8,000 a day, and micro Aussie dollar, micro pound that do respectable amounts. Yes, they're not as liquid as the larger contract counterpart. They're not as liquid as the mini S&P 500. But one little trivia fact you should know. People are wondering how will the micro E-mini compare with this? Well, we don't know. But we can make guesses. I can make a personal guess. This is not a personal guess from the Merck. It's my opinion only. But what do you think the top 3 contracts are, futures contracts are, traded by active traders, such as yourselves? Think about that. I'll give you one more second. It's the mini S&P is the #1 contract. I think it's followed by crude oil would be #2, and the currencies and gold are probably 3 and 4 neck and neck. So these do pretty good. Euro FX does pretty good. The crude does good. Their larger contracts are the top 2 of 3. So the E-mini S&P is #1. I can't help but think, again, this is a guess on my part, I can't help but think that the mini S&P, being the largest one, would create an environment where the micro S&P and the micro Russell and the micro Dow and the micro NASDAQ would easily get 1, 2, or 3% of the larger counterpart in time. Maybe not day 1 or week 1 or month 1, but in time they should do well. And if we get only to 1%, that's 16,000 a day. If we get to 10%, it's 160,000 a day. So we can be hopeful. Anyways, they'll be a great complement, the micro E-minis. It'll be a great complement. You'll have currencies available, you'll have metals, you'll have crude, commodities. So you'll have a whole micro suite available to trade a diversified portfolio of futures contracts for smaller traders. All right, so let's look at one of the other advantages we talked about earlier, precision trading, or being able to scale in and scale out. All right, and we'll use another thing. This comes from the trading simulator. This chart comes from the CME Group, our trading simulator. And we're going to talk about another trader that I know, although this is more of an illustration, not a real trade, but technical trader at a small CTA. CTA is Commodity Trading Advisor. They, instead of trading diversified portfolios of stocks or bonds, they put together diversified portfolios of futures contracts. So this one guy is a technical trader at CTA. He likes charts, and he likes RSI like my other trader friend. He decides he's going to sell when we break this head and shoulders headline. When we breach the neckline, he's going to sell, and he's going to sell short. So at that point, it happens 28.2650. I show it by an arrow there. He covers at any RSI reading on a 5-minute chart below 30. So below that on the simulator, you can also put up various studies like RSI, oscillators, things like that, moving averages. So the market goes in this direction. About an hour later, he covers at about 28.15. So he makes a quick 10 points. Which is pretty good. But if he does a mini, he sells one, and then he covers later, he buys one, he's out of his position. Well, we have the benefit of 20/20 hindsight. Look what the chart does after this. It keeps going down. So what if the trader, instead of doing one E-mini S&P, he executed 10 micro E-minis instead? So he would short at the neckline, the breach of the neckline, 10 micro E-minis. And then he'd cover where he originally covered 5 of them, or 6 of them, or a partial cover, and then cover the rest of them, maybe down a little bit lower as we headed lower, and then a little bit more. He covered the rest of the balance of his position if we went even lower. Again, this is one of the many reasons to trade the micros. Professional traders do something called scale buying and scale selling. Fortunately, they're afforded that opportunity for lots of reasons, but now with the micros, anyone could do scale buying and scale selling. And if you don't feel like, the courage of your conviction to do one mini, you might do 6 or 7 micros, depending on how strong or how weak your opinion is. And again, just in terms of strategy, you can get in and get out of a partial position, cover a little bit lower with some of them, and then finish out covering the position even a little bit lower. So it's something that traders do and have been doing for years and years and years. And it's a good way to trade. It keeps you in the trade a little bit longer, but yet still reduces your risk if you want. Or another possibility, the trader could have just executed the one E-mini contract as we originally talked about, but then he could have slowly offset using micros. Instead of just selling, offsetting his position with one mini, he does it with micros. So again, they're fungible. If you got short one mini S&P and you covered along the way and successively lower bottoms with 10 micro E-minis, you would be flat and you would be good. So your position would be flat and you'd have no risk. All right, Take a little breather here. We're going to look at just a real quick, that FANGs trade that everybody still talks about. My colleague here by my side, Craig Buick, has a couple of slides in his presentations where he talks about the FANG trade too. We always like to compare what people are doing in the stock market and the ETF market with what can be done in the futures market. And sometimes it's a favorable comparison, sometimes it's not. But in this case, it's a very favorable comparison. And we also, the micros will give people the ability to hedge FANG positions or just have a more diversified tech position. So I call your attention to the third row, average daily dollar volume. So you have Facebook, Amazon, Netflix, Google, the QQQs, all the FANGs put together, and then all the FANGs plus the QQQ. So Facebook does about 3 billion average daily dollar volume a day, Amazon about 8.5, Netflix 3.37, Google about 1.8, the QQQ is about 6 billion. Add them all up, it's $25 billion a day that the FANGs and the QQQ do. So you would think this is the most popular, most liquid thing you can do in the world, that these Facebook, Amazon, these FANG stocks are so liquid and so popular that why look at anything else? Well, there's a lot of reasons. One, you're only talking about 4 stocks. You will live or die by how they do. And, you know, there's been some sickening downturns in those stocks from time to time too. So, and it's taken some traders out of the market a little bit. So if you look at the mini NASDAQ 100, and again, this is not the micro, it's not trading yet, but it trades $67 billion a day. That's more than 2 times all the FANGs and the QQQ put together. But more than that, you get all the advantages we talk about. 24-hour trading, you don't get that in the FANGs and the QQQs. The 60-40 tax treatment, you don't get that with the FANGs and the QQQs. Diversification, you don't get that with the FANGs. You do with the QQQ, you get the other 96 issues in the NASDAQ 100. And with the micro E-mini and the mini NASDAQ 100, you would get all the diversification of the 100 stocks beyond the 4 of the FANGs. So again, the returns on the FANGs have been great. If you've been long over the last 3 or 4 years and held on, you did really, really, really good. But in time, you know, and that time came fourth quarter 2018, things headed south quickly. You can use the micro E-mini NASDAQ to hedge those positions. All right. All right, we're going to get into one last strategy, then into some other things, and then hopefully get ready for some Q&A here. But I want to just talk briefly about correlations. I'm not going to go over all these. It correlates the Russell 2000 with some other stock indexes here. So I call attention to the Russell 2000 versus the S&P 500. It's a 0.81 correlation. Not a perfect correlation, but it's a good correlation. And generally, they move lockstep and barrel, but occasionally they have divergences, and this is when the fun starts. The Dow Jones about a 0.749 and the NASDAQ 100 0.58, hardly any correlation at all. Technology goes on its own sometimes. You know, when the fourth quarter came, the S&P 500 was down 18% intraday. Tech and Russell 2000 were down a lot more. So be careful with correlations there. But these correlations, not being perfect, allow spread trading opportunities to come up. So we're going to talk about spreads. We'll get into one in particular here, but what you should know, certain spreads require ratios, and sometimes they're not 1-to-1. So if you wanted to spread the micro E-mini Russell versus the micro E-mini S&P 500, it would be a 2-to-1 ratio, actually. And if you don't do these things in the clearinghouse recognized ratio, you won't get the margin offsets. So they can only be done in accordance with the clearinghouse ratios, all right? You can do any ratio you want. You'll just pay more margin. So you want to check with the CME website. You'll definitely check with Interactive Brokers and see what they say margins are and things like that. So remember, the brokerage firm can supersede the Merc in terms of margin in different ways. All right, so here's the trade. Let's look at it, how it sets up. I'm not going to go over all this. Obviously, we're short-term traders. This is 20 years of data, and most people do not care about 20 years of data. But in general, small stocks outperform large cap stocks. Over the last 50, 75 years, that's been the case. Occasionally, the S&P 500 outperforms the Russell 2000. We're going to skip almost all the stuff on here and go to December 29, 2017. And you'll notice the Russell was up 12.6. And the S&P 500 was 18.87. So there was an outperformance of the S&P 500, an underperformance by the small cap Russell 2000 index of 623 basis points, or 6.23%. Now, look what happened just a few months later, July 20th, 2018. You had the Russell up, Russell 2000 small caps up 10.5, the large caps up only 4.8%. We completely reversed there, and now small caps are outperforming by 570 basis points. What happened in summer of 2018 that might cause this? If you all remember, that's when the trade wars and tariff issues with China started to surface. And what happened here is that large cap S&P 500 is mostly large cap multinational corporations. They do business overseas a lot. So a Caterpillar, a General Motors, a John Deere, these companies would be hit more by tariffs than small caps, which tend not to be multinational. So they underperformed. But then look what happened in December, just 5 months later, when we had this bear market. Well, why now are small caps underperforming? The tariff issue is still alive. Well, what overcompensated for the tariff issue is the bear market, the little nasty correction we had in November, December. When markets sell off, things that are less liquid will sell off more. What's more liquid? Large cap stocks, the S&P 500, or the Russell? Small cap stocks. If a pension fund wants to drop 1 million shares of a small cap stock versus IBM or Johnson & Johnson, they're going to have an easier time getting out of Johnson & Johnson than a small cap stock. They won't move it down as much. So as a result, so now year to date, look what happened as of March 21st. I got to update this, but it's about the same. The S&P 500 and the Russell are about the same now. So within the last year, you've seen multiple opportunities where the Russell 2000 versus its performance versus the S&P 500 have flipped a couple times. So again, as a trader, lights should be going off in your head. Hey, wait, there's a trading opportunity. There's a spread trading opportunity here. So here's a little strategy continuum here. Just have, if you know what your outlook is, what's your strategy, what's the ratio, what's the margin offset. We're looking at small caps outperforming large caps or large caps outperforming small caps, the reverse of the trade. The ratio is 2 to 1. You do 2 micro E-mini Russells to 1 micro E-mini S&P 500. The margin offset, if you do so, is 80%. So let's go drill down even further. Again, on the left hand of this panel, you see the ratios that you will need and the margin offsets if you do those ratios between all the micro E-mini products. Now, on the right panel, you see the micro E-mini Russell. You got to do it 2 times. The margin's $391 per, so it's $782 for that leg of the spread. For the micro E-mini S&P, you have to do 1 contract, $660 is the margin. The gross margin on both legs is $1,442. The offset, margin offset, the little deal you get by doing both trades at the CME and the clearinghouse is 80%. So the total margin for this thing is $288. Less than a dinner at a fancy restaurant in Chicago. All right, next topic. We're going to be wrapping up in a few minutes and taking questions. Have there been a lot of questions, correct?
We've got a few.
Good. All right, that's good. Yeah, we've had hundreds of questions over the last couple of days. And it's, like I said, the buzz for this contract's really, really good, and we're excited about it. I've been doing this for 31 years. This is probably even more so than the E-mini S&P 500. The attention paid to this is big. The buzz factor is very, really big, so we're looking forward to it here. So we have Trader A, Trader B. They both make $1,000 of profit on a short-term trade. We're going to assume they're both in the 32% tax bracket, and Trader A, Trader B are going to have very different outcomes. So Trader A is taxed according to Section 1256 of the Internal Revenue Code. Forget all that. It just means the 60-40 rule, which means 60% of the gain is taxed at long-term capital gains rate. Now, if you're in the 32% tax bracket, your long-term capital gains rate is 15%. At higher tax brackets, that can go up as high as 20%. So 60% is long-term capital gains. 40% of it is taxed at ordinary income. So the blended rate is about 21.8% for someone in the 32% tax bracket. So you give up $218 to the IRS. Trader A keeps $782 per thousand of profit and pays $218. Trader B keeps $680 per thousand and pays $320 because he's going to pay all ordinary income of $320, 32%. You may say, Dave, big deal, $102. Well, if you're a good trader and you make $50, $100, $200, $300,000 a year, do the math. It'll be a substantial amount of money, like several first-class vacations to Thailand. There'll be a lot of difference. If you're a good trader, you're going to pay a lot more trading stocks and ETFs than you are futures. All right. And again, the difference can be dramatically higher in the 35 or 37% tax brackets too. Again, you have to do the math and always consult a competent tax advisor because the Internal Revenue Code applies to 337 million Americans. And I am not one of those people that understands the Internal Revenue Code. I think there's only 10 people in the country that do. Anyways, all right, real quick, options. Micro E-mini is an alternative to options. Now, so that you don't ask, there will be no options on the micro E-minis. We have no plans to trade options on micro E-minis. This is a different example to look at the micro E-mini futures as a possible alternative to options, or as something that can hedge an option strategy too. But as you know, options offer a lot of characteristics compared with futures. They're great. They're small premiums. They give you leverage, limited risk, lots of strategies. Options require thinking beyond 2 dimensions though. Futures, all you care about is up and down. Options, you have to worry about up, down, time to expiration, and volatility. So let's look at a couple of option strikes versus the micro if it was trading. All right, we're going to skip the slide there. It just showed volatility changes relative to the S&P 500. So we have the micro futures price there. This is really the E-mini price. I'm doing a hypothetical guess here that the micros are going to trade very similar to the E-mini S&P 500. By virtue of spreading and arbitrage, they should be close to each other. But let's just assume that micro prices are trading as such. We have implied volatility. I have the E-mini March 28 call option and the E-mini March 28-20 call option. You can see the premiums. This is over a period of time, the last 2 weeks going into the March 2019 expiration. So what if you're a trader and you think the market's going to go up? Well, if you're an options trader, you need the market to go up, and you need it to go up above the break-even point. So if you pay 23.4 for a premium, your break-even point is 2,800 plus 23.4, so 2834. Excuse me, 23.4 is the break-even point for the March 2800 call option. The March 2820 would be 2820 plus 14, which would be 2834.2. So if your rally doesn't take you up past the break-even point, you will lose some of your premium, or in some cases, all of your premium. So let's look at the trade and how it went. Go all the way down to March 15th, 2019. Expiration day, 2811.90 is where the S&P ended up. The P&L in points was 20. The volatility dropped from 12.43% in February down to 10.454. All you options traders out there, you know that a decrease in implied volatility, or Vega, is going to adversely affect your long options position. So look at the March 2800 call. It had some big dips there, and then it had some nice rallies, but it expired at 11.9. In other words, you lost 11.5 points, or $575 per option. The March 2820 call option, you lost the whole premium because you didn't get anywhere near 2820 at expiration. So your P&L for the micro E-mini would have been $102, but it would have been $400 if you did a delta adjustment, because the E-mini is an E-mini. The call option on the March 2800 call option is on the E-mini, and delta adjusted, you'd have to do 4 micros to hedge that off. The delta adjustment for the 2820 call option would be 3 contracts. So you'd do 3 micro E-minis, and that would give you $306 in profit. So you either made $100 in profit, or $408, or $306, depending on if you hedged the option via delta. So you have time decay considerations with options. You have volatility considerations. Again, the contract size is so small for the micros. In a very strange way, you can look at it as such a cheap futures contract that it has some optionality to it, although it doesn't have the limited risk feature. Although on the long side it does. On the short side it does not. Real quickly here, you can take volatilities, and I have 3 volatility environments: low, medium, and high. And you can convert them to daily, weekly, and monthly movements. I just put this chart up here. We're going to not go over all this, but it'll show you the movement, what to expect under different volatility environments, and a 1, 2, 3 standard deviation move, which for those of you that don't know, 1 standard deviation move greater than that occurs only 1 out of 3 times. 2 standard deviation move is 1 out of 20 events, and a move of greater than 3 standard deviations is about 1 time out of 200. So you can see there on average, in a high volatility environment, the mini S&P will move $2,100. The micro will move $218. So you'll notice everything on the right-hand panel is exactly 1/10 the amount, which is basic math, obviously. And it'll just give you an idea of what to expect in daily movement. All right, so that was just additional information for you folks. All right, so as we get into the end here, We're going to have market makers. I think we have 20 of them signed up now, and we have 8 that are going to do in non-U.S. time zones. So we should have good markets in the Asian time zone and the European time zone. And I know we have 79 countries that are lined up for this thing, this webinar. Cynthia had shared with me, we have people from all over the world, which is good. You have the offset feature, not true fungibility, but you can offset 1 mini with 10 micros. Price quotes will be available through all major quote vendors. We also have delayed quotes on CMEGroup.com. New traders, I'll go over this really quick, but their futures contract, as such, they're going to have to be traded out of a futures account. It's not complicated, some additional paperwork, risk disclosure, and things like that, but most trading firms allow futures trading. Most online firms allow futures trading. Obviously, Interactive Brokers does. There will be a minimum. There'll be minimum account thresholds and other requirements to trade futures, and they vary from broker to broker. Shorting futures is much easier than doing stocks and ETFs, and margins with futures are different than margin with stocks and ETFs. So you should be made aware of that and do your homework on that. CME Institute, place to learn more about futures and options. I don't care if you know nothing about futures or you've been doing this for years. There's a lot of classes, resources. There's a trading simulator, and lots of things to help you sharpen your skills. So, and go to cmegroup.com/education for more information. Remember to keep up with your key economic reports, especially if you're a new trader. These things have the ability to move a market and move it substantially, and you want to be aware of these things when they come out. All right. Key takeaways, we're launching 4 index contracts, micro E-mini S&P, micro NASDAQ 100, micro Russell 2000, or micro E-mini Russell 2000, micro E-mini Dow Jones Industrial Average, or Dow. You get versatility, you can fine tune and have precision exposure, scale in, scale out, tax advantages. You get a slice of a very liquid equity complex with 1/10 the size. Capital efficiency, margin, leverage, very low cost versus ETFs and stocks. And again, another site within our site, activetrader.cmegroup.com/micro-e-mini to give you even more information. There's FOQs available. I think Cynthia put something up that you can reference, a FOQ, a 2-page sheet that we have that we're going to be handing out at various conferences and things like that. I'm the presenter, Dave Lerman. Feel free to email me on this at any time or call any of the other names on this list. They probably prefer emails. They're all traveling a lot because of the micro launch, and we definitely want to thank you for all your support and for all of you logging on. And just remember, if you're ever having a really, really, really bad day, in 1976, Ronald Wayne sold his 10% stake in Apple for $2,300. It's now worth $70 billion. So with that, we will take questions. We got a few minutes, and I have permission to go a little bit over if necessary, but we're polling for questions. I know they've been being answered a little bit along the way.
Thanks, Dave. Great job. A couple questions that we got from multiple people just to kind of get out of the way. We got a lot of questions on commissions for these, to which, if you missed it, Cynthia replied that Interactive Brokers is going to be updating their fee schedule on their website over the next few days. Cynthia can correct me if I'm wrong there, but she's indicated that the updated commissions for these products will be on IB's website, but are not out there yet. Similarly, we got a lot of questions on margins, and Dave went over and alluded to it about 10 minutes ago, the CME margins on this, and he was explicit in that IB may charge the same or may charge different. So that's another thing that you can look for IB or Interactive Brokers to update on their website for the specific margins. We had a question on volatility. Dave talked about volatility a couple of different times. We were asked how to define or how to calculate volatility. And without going into the math behind it, I think when we talk about volatility, a lot of times we talk about one of 2 different kinds of volatility, either historical, which is a measure of what's happened over a given number of days in the past and annualized for the future, or implied volatility, which is what the options market is suggesting they think that the future is going to do in the future. So historical volatility is a measure of what's happened. Implied volatility is what the options market is saying they think is going to happen. And those are the 2 kind of volatilities that we generally will talk about when we do these sorts of presentations.
These were implied.
So Dave just pointing out to me that when he was talking about vols, he was talking about implied volatility, which is calculated using one of multiple different options calculators, option pricing calculators you may use. And it's a measure that kind of falls out of the option pricing math. So the scope of the actual math that goes into it is beyond beyond what we're talking about here, but just know that it comes out of option pricing.
If you want, refer to Shelley Natenberg, his book, Options Volatility, or Options Volatility and Pricing. He has the formulas in there. They're very simple math formulas. They're square root functions. That's all you do. On a daily one, you take the square root of 252, the number of trading days. You divide volatility by the square root of 252. Weekly, there's 52 weeks, so you take your annual volatility and divide by the square root of the number of weeks. And monthly, there's 12 months, so the square root of 12. So annual volatility divided by the square root of 12, and you convert to a percent, and it's simple. But Shelley Natenberg has examples of all that stuff. And Quick Strike, we have a wonderful tool on our website called Quick Strike, and you can get updated volatilities in terms of implied volatilities and historical volatilities.
We had a question on market data, and I can understand where the confusion. All of these products will be listed on what we call CME Globex, which is our central match engine for all of our products. For anybody that's paying for market data, we charge differently per exchange, and that kind of goes into the exchanges that make up CME Group, which are CME, CBOT, NYMEX, COMEX. And so with these products, the S&P, the NASDAQ, and the Russell will all be what we call CME listed products in terms of market data, while the Dow is a CBOT product in terms of market data. And that's just for anybody that's paying for market data. We had a question on whether there are day trading restrictions for accounts less than $25,000 on these products. I believe that question probably refers to the SEC pattern day trading rule, which does not apply to futures. So that if that is in fact the context of that question, it will not apply to these products. Was asked to explain market makers. Dave talked about how we have market makers lined up to support this product launch. Basically, market makers tend to be professional trading groups or a trading desk at perhaps a bank who make it their business to supply two-sided markets in different products all day long and all night long. So CME Group will contractually contract with some of these groups, provide incentives in order to get them to make those two-sided markets for new products that may not be established. So when Dave talks about 20 market makers, that means that 20 trading groups have contractually obligated themselves to make prices on these products for CME. We had Dave mention, make sure you know about the economic releases and economic calendars that can impact these markets. We had a question on where to find those. Dave also mentioned Quick Strike a couple minutes ago. If you go to the Quick Strike section on CME Group's website, there's a economic release calendar, and it's specific to different asset classes. So what might affect the price of oil may not affect the S&P and vice versa. So if you go to that Quick Strike section, you can find economic releases in a calendar that is specific to the equity asset class. I'm looking through some of the other questions here.
Craig, while you're looking through the other questions, I'd also like to point everyone's attention over to the control panel. You'll find a handouts title bar. If you double click that, you'll see that we've included 2 PDFs that are available for each of you, and you can simply click those and save the frequently asked questions as well as a fact sheet on each of these micro E-mini futures. So you may want to grab those before you do exit today's session. Okay, back to you, Craig.
Great. We've gotten a question. We already addressed the question about IB commissions, and Cynthia has addressed that. I got another question about what are the CME Group commissions on these, and there'll be 20 cents for the micro products. So I got a question, will it be different than the larger contracts? So the answer is yes. They'll be less expensive than the mini. Do we plan to roll out similar micro products for commodities? right now we're focused on these. This is as Dave mentioned, this is the title of this presentation. In fact, this is the biggest thing that we've done in a while here, at least in terms of equity indexes. We're focused on the success of these products right now, and assuming they're successful, which we all are, we'll analyze what we might do in the future then.
Anything's possible. We're a lot of times we are customer demand driven. So if enough people scream for a micro bond contract in the next year or two or three, maybe we'd be able to deliver it. But right now, no plans for options on the micro E-mini equity futures, and no plans for a micro crude at this point. We have a mini crude. It's pretty small, so check that out if you wanted a smaller crude contract.
A lot of people are asking for the presentation. If anybody missed Cynthia's response, Interactive Brokers will be posting these slides, I believe, on YouTube. And whether they're going to, Cynthia, you can perhaps.
Actually, Craig, everyone's going to receive a copy of today's recording. We have been recording the session, so you'll be able to revisit any of the concepts that Dave discussed today via the playback, and it will be available on demand. I'll be sending you a follow-up message shortly after today's event ends that includes that recording link as well as a link to the slides that Dave's been using for today's presentation. So if you do want to come back and revisit the concepts or recheck the slides, simply watch your inbox later on today for a direct link. These will also be posted on the Interactive Brokers website as well. So did want you to be aware of that. We'll get the recording link out and also be posting the notes. Underneath the education menu, there's a webinar section where you can find the recordings, and you'll see today's event will be listed there along with the webinar notes.
Thanks, Cynthia. Just a couple more questions we have time for. Got a question on whether these are very liquid. They launched Sunday night. It kind of goes back to the market maker question. Our market maker program was actually oversubscribed. Dave talked about 20 and 10. The market makers are excited for this. Dave talked about the fact that these should trade very similar to one another because otherwise you find arbitrage opportunities that should be taken out of the market. So we anticipate these to be liquid products upon the launch, which leads me to the next question. When are these launching again? It's this Sunday night, 5 o'clock Chicago time. And
yes, May 6th, they launched. Trade date, they'll trade Sunday night, but any trade done on a Sunday night is for trade date May 6th. So even though you'll be trading on May 5th, anything done on a Sunday night will be for trade date Monday, May 6th. So May 6th is the launch date, even though you can trade them Sunday the day before. Yeah, the liquidity question, I wish we could answer it. You know, day one, this thing could do 5,000 contracts. It could do 50,000. We don't know. We've been pleasantly surprised on a lot of contracts, and I think this one we're going to be pleasantly surprised. It'll depend on folks like you, so trade it. The more you trade it, the more liquidity you'll have. Not to be blunt, but anyways, if we'll take one more question maybe, and then we'll wrap it up here because we don't want to go too far over the hour. We want to respect your time and Cynthia's time too, and Interactive's time as well. But we'll take any more.
Yeah, I think we're pretty good. We're getting a lot of requests to have a micro WTI crude contract. We hear you.
We will pass that along.
Yeah. So thank you very much.
Yes, we really appreciate it. Again, on behalf of the CME Group and Craig and myself, Cynthia, thank you. And to Interactive Brokers, thank you all very, very much. And to all that logged on, a huge thank you. And thanks for all your business over the years for those of you that have been trading our products.
Well, Dave and Craig, thank you so much for today's information. This has been terrific and a great introduction. I also want to thank all of you for joining us here this afternoon. That is going to conclude our session today, but as I mentioned, we have been recording today's event, and you'll each get a direct link to today's recorded playback later on this afternoon, so do watch your inbox. With that, thank you so much for your participation in our event and to the CME for delivering these upcoming products. So thanks, everyone. follow up, or I do want to wish everyone a great rest of your day. So thanks all. Have a good one.